The wealth you created over the years will disappear. Maybe you wake up penniless tomorrow. And this isn't about bad investing. For the last 40 years, money flowed into stocks, real estate, and tech. But that picture is gradually changing. Investors call this moment a wealth rotation, and the early signs suggest it may have already begun. So, where is the money going next? To learn the answer, you need to step back all the way to the end of World War II. 1944, World War II is still raging. Europe is already struggling under 6 years of destruction. Cities lie in ruins. Entire industrial regions across Germany, France, and Eastern Europe have been flattened. Railways function only in fragments. Factories stand damaged or abandoned. Rebuilding these economies will cost enormous amounts of money, but governments simply don't have it. Their currencies are unstable. Global trade barely functions. The problem had already appeared once before. During the 1930s, currencies collapsed, competitive devaluation spread, and protectionist tariffs shattered global commerce. International trade nearly stopped. Leaders fear the same mess will return after the war. There's no stable financial system left anywhere. In such a situation, rebuilding Europe feels like building castles in the air. Some leaders decide to solve that problem. Bretton Woods, New Hampshire, July 1944. Delegates from 44 countries gather in a mountain resort. The conference takes place under the leadership of U.S. President Franklin D. Roosevelt. 2 economists help design the framework. British economist John Maynard Keynes and American official Harry Dexter White. They're here to create a monetary system that nips another global economic collapse in the bud. So they build a new structure. Currencies around the world will link themselves to the US dollar, and the dollar itself will be tied to gold. The choice isn't accidental. The United States already holds nearly 3/4 of the world's gold reserves. Unlike Europe and Japan, its industrial base is still intact. These days, American factories make almost half of the global output. Under the agreement, foreign governments can exchange dollars for gold at a fixed price of $35 per ounce. To support the system, 2 new institutions are created. The International Monetary Fund, designed to provide emergency loans when a country's currency collapses, and the World Bank, which finances large reconstruction projects like roads, power plants, and industrial infrastructure. The following year, in 1945, the war ends. Europe rebuilds, factories reopen. In the early years, the world actually faces the opposite problem: a shortage of dollars needed for trade and reconstruction. American capital flows overseas through aid programs and investment. Gradually, the global economy stabilizes. For nearly 2 decades, the system works almost exactly as designed. But by the late 1960s, the United States began creating more dollars than its gold reserves can support. War spending in Vietnam expands. Domestic social programs grow. Military commitments stretch across the globe. Dollars flood the international system. Foreign governments can't hold their anxiety now. Some start exchanging their dollars for gold. American reserves begin draining way too fast. If the conversions continue, the United States risks losing the gold that holds the entire system. The pressure builds for years. Then, on August 15, 1971, U.S. President Richard Nixon makes a decision that changes the financial world forever. The United States suspends gold convertibility. Foreign governments can no longer exchange dollars for gold. The Bretton Woods system collapses overnight. The dollar becomes a pure fiat currency. Credit expands. Financial markets grow rapidly. Wealth no longer needs gold to increase. From that moment forward, money begins flowing somewhere else entirely. Can you guess where? Drop it in the comments and let's see if you get that right by the end. Now imagine you're an investor in the early 1980s. The gold anchor was gone. The dollar floated freely. The financial system you were living in was completely different from the one your parents knew. At first, things looked frightening. Inflation was swallowing the United States, so the Federal Reserve made a brutal decision. In 1979, Chairman Paul Volcker pushed interest rates to nearly 20%. Borrowing money suddenly became painfully expensive. Businesses slowed down. A recession hit in the early 1980s, but the strategy worked. By 1982, inflation finally broke, and then interest rates kept falling year after year. By the mid-1980s, borrowing money became easier again. By the 1990s, it became the norm. By the 2000s, it had become absolutely cheap. And every time borrowing got cheaper, money flooded into assets. First, the stock market began climbing. If you had bought shares of the S&P 500 in the early 1980s, you would have watched your portfolio multiply again and again. Because at that time, corporations were expanding across a changing global economy. Then real estate joined the surge. Lower mortgage rates made housing loans cheaper. Property prices began rising across the United States, Europe, and eventually much of Asia. But the real acceleration arrived in the 1990s. Globalization suddenly sped up. Trade barriers fell. Supply chains stretched across continents. And one country changed the entire economic landscape. China joined the global trade system. Factories began moving overseas. Manufacturing shifted from the West to lower-cost economies. Goods became cheaper to produce. You started seeing the results everywhere. Electronics cost less, clothing cost less. Consumer goods flooded store shelves at prices that would have seemed impossible a decade earlier. Inflation stayed surprisingly low. And that created the perfect environment for the financial system. Central banks could keep lowering interest rates without triggering runaway inflation. Cheap credit continued flowing, and asset prices exploded. Stocks rose, so did real estate. Tech companies began dominating markets. Then the internet arrived. Personal computers entered homes. Online businesses appeared almost overnight. Venture capital poured into Silicon Valley. Small startups suddenly became billion-dollar companies. If you had invested early in companies like Microsoft, Apple, Amazon, or Google, your wealth could grow beyond anything earlier generations experienced. And each time the economy slowed, the same rescue appeared. Central banks cut interest rates again. More credit entered the system, and asset prices rose even higher. Over time, you begin to understand the new rules of the financial world. Money no longer flows toward gold. It flows toward financial assets, and for nearly 40 years, that strategy worked beautifully. Buy stocks, buy property, invest in the next technology wave. Wealth compounded faster than almost any period in modern financial history. But beneath that prosperity, the system ran on a fragile engine: debt. Because the larger the system grew, the more borrowing it needed to keep expanding. And eventually, the numbers started getting way too uncomfortable. By the early 2000s, the wealth machine looked unstoppable, and one sector began expanding faster than the rest. Banks started issuing mortgages on a massive scale. Borrowers with strong credit still qualified easily, but the rules began loosening. Soon, even buyers with weak credit histories would receive loans. These mortgages became known as subprime loans. At first, nobody seemed worried. Housing prices kept rising year after year. As long as the value of homes increased, lenders believed the risk could always be managed. But banks were no longer keeping most of those mortgages. Instead, thousands of home loans were bundled together and turned into financial products called mortgage-backed securities. Those securities were sold to investors around the world: pension funds, European banks, insurance companies. Everyone bought them. American housing debt spread across the entire global financial system. For several years, the profits looked incredible. Then, by 2007, housing prices stopped rising in many U.S. cities. Some borrowers began missing payments. Default started increasing. In those mortgage securities, losses began spreading. At first, the damage looked manageable. Then the panic reached one of the largest names on Wall Street, Lehman Brothers. The firm had existed for more than 150 years. It had survived the American Civil War, the Great Depression, and 2 world wars. But by 2008, Lehman was exposed to collapsing mortgage securities. As housing losses spread, the firm's balance sheet began to crumble. Investors started pulling their money out. Over one frantic weekend in September 2008, regulators and banks tried to arrange a rescue. No buyer stepped forward. On September 15, 2008, Lehman Brothers filed for bankruptcy. The shock spread instantly. Money market funds froze. Banks stopped lending to each other. Companies suddenly struggled to borrow even short-term cash. Stock markets collapsed across the world. For a few terrifying weeks, the global financial system looked dangerously close to breaking. Governments rushed to contain the crisis. Banks received emergency capital. Financial institutions received guarantees, but the rescue called for more. Central banks started creating money on a scale the modern world has never seen. The Federal Reserve launched quantitative easing. Instead of simply lowering interest rates, it created trillions of dollars electronically and used them to buy financial assets. Other central banks followed. Liquidity flooded the system again, markets stabilized, stocks recovered, and real estate began climbing again. Technology companies surged even faster than before. But, ironically, the rescue that saved the financial system in 2008 planted the seeds of the next crisis. The Lehman crisis eventually stabilized, but the rescue policies never fully disappeared. Interest rates remained near zero for years. Central banks continued to inject liquidity into financial markets. From 2009 to 2019, the world experienced one of the longest bull markets in history. Stocks climbed steadily, real estate recovered and surged again. Technology companies became trillion-dollar giants. The system appeared stable again, but it had become way too dependent on cheap money. Then 2020 arrived. The COVID-19 pandemic disrupted the world. Within weeks, airports emptied, offices closed, entire economies slowed almost overnight. Governments feared a global depression, so they reacted with the largest financial rescue in modern history. In the United States alone, Congress approved more than $5 trillion in stimulus. Households received checks. Businesses received emergency loans, central banks opened the money taps again, the Federal Reserve cut interest rates back to zero. Then it began creating money even faster than it had after the 2008 crisis. At first, the old formula seemed to work again. Stock markets shot upward. Technology companies reached record valuations. Venture capital flooded startups. Housing prices jumped across major cities. But something was going wrong. Shipping costs suddenly surged. Energy prices rose. Supply chains struggled to restart after the shutdowns. Everyone believed the pressure would fade. It didn't. Food became more expensive. Rent climbed. Fuel prices spiked. By 2022, inflation in the United States reached the highest level in 40 years. Central banks could no longer ignore it, so they reversed course. The Federal Reserve began raising interest rates at the fastest pace since the early 1980s. Borrowing costs climbed from near zero to above 5% in little more than a year. The shock moved through the financial system. Mortgages became expensive. Corporate borrowing slowed. Venture funding tightened. The same force that had lifted asset prices for 4 decades suddenly began working in reverse. Cheap money disappeared. And once that fuel faded, the old wealth machine began slowing down. Stocks stumbled, real estate markets cooled in several cities, technology valuations shrank. For the first time in decades, investors began asking a different question. If the old assets could no longer deliver the same returns, where would the next wave of wealth appear? Now look at where the biggest investments are going today. You can already see the change taking place silently. For decades, money chased financial assets, stocks, venture capital, technology startups. But now the attention is moving somewhere else. Take semiconductors. In 2022, the United States passed the CHIPS and Science Act. It committed over $50 billion to rebuild domestic chip manufacturing. Companies like Intel and TSMC started building massive new fabrication plants in Arizona and Ohio. Europe followed with its own semiconductor strategy. After decades of outsourcing, governments suddenly wanted factories back. Energy tells a similar story. Oil investment had collapsed during the 2000s as money poured into tech companies instead. But once global energy shortages appeared, profits in the sector spiked again. Oil giants like ExxonMobil and Saudi Aramco began posting record earnings. But building that new industrial base requires something very basic: raw materials. You can see copper demand is rising as countries expand power grids and electrify transportation. Lithium mines are expanding to support electric vehicles and battery storage. Even the defense industry has returned to the spotlight. When Russia invaded Ukraine in 2022, military spending surged across Europe and the United States. Companies that manufacture missiles, drones, and advanced weapons suddenly faced a flood of new government contracts. So the pattern becomes pretty clear when you compare the two eras. For the last 40 years, wealth flowed into financial assets. And in the emerging cycle, money is gradually moving toward the physical backbone of the economy. In the previous era, fortunes were built by writing software. In the next one, they may be built by securing energy, minerals, factories, and supply chains. And if that shift continues, the next generation of wealth may not come from the same industries that dominated the last 40 years. Because every economic era eventually rotates. The last cycle rewarded financial innovation. The next one may reward control over the real-world economy. What do you think? If the global wealth machine is truly rotating, which country will capture the biggest share of the next cycle? Leave your thoughts in the comments and hit that subscribe button if you haven't already. History does not just repeat, it rhymes. So make sure you're listening for the next Money Echoes. Subscribe, and I will see you in the next one.